And good afternoon, everybody. Welcome to ETF Edge, your go-to place for everything ETFs. Got an interesting show today. A lot of very important things happening in the ETF world today. Joined today by Mike Akins of ETF Action and by Bryon Lake. He's the head of America ETF distribution for JP Morgan Asset Management. And Mike, let me talk to you first. I am getting an awful lot of questions about what's going on in oil today, and particularly what's going on with oil ETFs and the USO. That is the largest oil ETFs. And I think this might be a very good teaching moment for us to explain exactly how these work. And maybe you can help us out since you're an expert in this area. These commodity ETFs tend to own futures contracts. In the case of USO, they own the front month contracts, the two front month contracts, mostly the most immediate one and the one right after that. We're seeing the May contract, which is expiring tomorrow, collapse today. It's been fluctuating all morning between $5, $7, $8, $9. The June contract is $22. I'm wondering if you can explain why this is happening. Obviously, it seems like a very large number of people are trying to get out of the May contract. I understand that about 25% of the contracts may be owned by USO at this point, and a lot of people are simply trying to get out and sell at any cost and don't want to take delivery of this. Can you give us a little explanation of what's going on here?
Certainly. So first and foremost, it's important to note that USO is no longer in the May contract. USO's methodology is to roll out of their contracts 2 weeks prior to expiration. So actually, they rolled out of May into June the week of April 7th. They do that over a 4-day period. So with respect to what's going on currently with May into June and that huge contango, that huge disconnect between the price of May contracts and June contracts, it is not directly related to USO, even though USO, as you said, does own a significant percentage of contracts of the month they're currently holding. So right now they're currently holding the June, and as you alluded to, 20% of that is into July. And the reason they recently made that change from June to July is simply to allow for more liquidity and to deal with ownership limitations around single contracts. So they were approaching over 25% of the ownership of the June contract and needed to change that methodology to avoid breaking those single ownership rules in the contracts.
So let me just ask the most immediate question, because the ETF haters are going to be out and they're going to be saying, aha, the reason we have this disconnect, this huge difference between the May and the June contract suddenly is because some of these ETFs own a significant amount of these contracts. They don't want to obviously take any possession. So people have been piling into them for whatever reasons, Mike, to short them or to hedge them, and that's causing some kind of disconnect. It's not the ETFs that are causing the particular problem here. I want to get that from you. What is your opinion?
So specifically with the May to June right now, that would not be USO simply because it already rolled out of its contracts. Now, the ETFs in general do have a play in this, and with respect to USO in particular, I think it's important to point out to the audience that historically USOs had an inverse relationship. The price of USO has been an inverse relationship to the shares outstanding. That meaning that as price goes down, shares outstanding have historically gone up and vice versa. And the rationale for that is because the demand, as volatility increases in the price of oil, the demand for this product goes up. But it's very important not to use that as a way to assume that people are getting long the price of oil, because these strategies, these are trading tools. They're not allocation tools alone. And as a result, as you mentioned, flows don't dictate the position of the actual traders.
Right. And Mike, I don't know if you have any thoughts on this in general on how these commodity ETFs work, but this is what I saw last week. We saw huge inflows into some of these commodities, into USO, but obviously some people felt they're probably not betting that oil is going to go up. They're probably betting, at least in a short term, a short here at this point. So do you have any thoughts about how these are constructed, these commodity ETFs in general, and what, if anything, we can do to improve them, or do they need any improvement?
So I don't think they need any improving. They are designed to be a tool, and directionally they capture the movement of oil. As you get into steep contangos, or historically, looking back, past recent 10 years, backwardation would actually go in your favor to do the roll. You have to understand that there's going to be a negative roll yield right now with the steep contango, and understand how long you want to be in the market. But I always say with respect to these trading tools, there's a lot of tools at Home Depot I can buy that I have no business using. And that's very important to note that a lot of these ETFs, you can buy them, but you need to really understand them before you start using them.
Yeah. Well, Bryon, isn't that the problem with these commodity kind of ETFs or anything where you're owning futures contract? You have what Mike called that negative roll yield. So if you have to pay more for the futures contract the next month, you're over time, you've got this perfect decay. You're guaranteed essentially to lose money. Here's a particular situation where it's going to be fairly difficult. Any thoughts on what we can do to improve the ETF role here, or is there any problems at all? Maybe I'm trying to create a problem where there isn't one.
Yeah, no, I don't think there is a problem here, Bob. Right? I think there's a couple of things going on. First of all, this is a really efficient way for investors to express a view, and so if they're able to use this ETF to express that view, that's a tool that is helpful to their portfolio. The second thing is just taking it back to a little bit of history here and why the futures contracts were invented in the first place. It's next to impossible to get spot price or to store oil. It's very expensive. In fact, I was Googling it earlier today. I think a used oil tanker is about $42 million right now. And you can only hold about 2 million barrels of oil on that. And so you create a futures contract in order to give yourself the ability to get the exposure or hedge your exposure or your risk within your portfolios. And so by having it delivered through an ETF vehicle that's exchange traded, that's available in these structures, that actually is a helpful tool for investors to express their views. They just need to make sure they understand how they work.
Right. And Mike, last week, just getting back to the point, because I got a whole bunch of emails about this, there was a huge number of creations last week in the USO. And I know you say it moves creations tend to move in opposite direction to the price. Is this people who are betting that suddenly oil is going to dramatically increase over the next couple of months, or is it hedge funds who are hedging or shorting? What creates there was a dramatic increase in new creations last week.
So it's all of the above. To the extent that, looking at flows into this product in particular does very little on a real-time basis to understand how the product's being used. I'm certain there's a portion of this that is long. People are saying, oil can't go any lower. I want to get a short-term directional bet on it. There's folks that are trying to short it, but because of regulations, there's not enough shares outstanding. So as a result, there's this mechanism called create to lend, where the authorized participants are creating shares so they can lend them out to people that want to go short. And there's a million different vehicles in between with respect to hedging and different active trading strategies where folks are using this product in line with other products to reach certain outcomes. So it's just really important to note that there's no real connection in the short term to the flows of these other than they need the liquidity, and shares outstanding increases liquidity. And that's why you see an inverse relationship between shares outstanding and volatility.
Okay, we're not going to solve anything. I'm bringing this up. I've dwelt on this for a little bit of an extended period because I think there's going to be a lot of postmortems on this, and I think the people who are unhappy with the ETF structure are going to try to use this as a scapegoat to point out certain deficiencies they find in this. I don't, and I agree with you guys, but I think it's going to be out there for a while now.